Buy low, sell high. It is the first rule of investing. It's the advice your uncle repeats at every barbecue, and on paper, it sounds like the only logical way to manage your money. Meet Cole. Cole takes this rule seriously. He keeps his cash safely in a savings account, watches the market, and waits. He knows the market will eventually crash, and when everyone else panics, he plans to back up the truck and buy at a massive discount. Then we have Carol. On the first of every month, Carol throws $300 into a broad index fund. She does not look at the news. Market at an all-time high? She buys. Blood in the streets? She buys. She set up an automatic bank transfer years ago and more or less forgot her brokerage password. One of these people is using their brain. Cole feels like a confident man who has absorbed the wisdom of Warren Buffett. Carol's strategy, by contrast, looks reckless. She is intentionally buying on objectively terrible days, paying top dollar at the peak of the market. They both start on the exact same day, with the exact same amount of money. Over the next 40 years, one of them gets quietly, mathematically demolished, and it is the one trying hardest to win. To understand why Cole fails, we have to look at the baseline realities of the stock market. Since 1950, the S&P 500 has closed at a record high on roughly 7% of all trading days. Overall, the market is positive in 3 out of every 4 years. Let's put our meal timeline on that math. From March of 2009 to February of 2020, the market climbed for nearly 11 straight years without a single bear market. Picture Cole sitting through that entire run. His cash is sitting in a savings account, earning almost nothing, while he refreshes his watch list, waiting for the inevitable drop. Over that exact same stretch, the market returned around 400%. Every month Cole waits, Carol is buying. Her money compounds on top of the money she put in last month, which is compounding on top of the month before that. Cole isn't betting on a coin flip. He is betting against a loaded coin, over and over again. In practice, waiting for a dip usually translates to waiting for a price you will simply never see again. This chart establishes the baseline for a 20-year test run by Charles Schwab. They analyzed 2 decades of market history to see exactly how different timing strategies stacked up against each other. The first investor had magically perfect timing. For 20 years, they bought at the exact lowest day of the year. They finished with $186,000. Carol's mindless autopilot strategy finished at $166,000. 2 decades of godlike perfect timing beat a woman on autopilot by roughly $1,000 a year. Then we have the cash waiter. Cole's strategy of keeping his powder dry finished with $47,000, barely a quarter of what the woman who never looked at her account made. Schwab ran one more investor. This person bought at the exact peak of every single year, the worst possible day, on purpose. That cosmic disaster of a portfolio still tripled the cash waiter. Being in the market on objectively terrible days was a rounding error. Not being in the market at all was the catastrophe. Maybe 20 years isn't a fair test. A researcher named Nick Maggiulli built a simulation covering every 40-year stretch going back to 1920, and he gave the dip buyer an omniscient crystal ball. This investor perfectly spots the exact precise bottom of every major crash and buys there. Even with perfect knowledge of the future, the omniscient dip buyer loses to the mindless monthly investor roughly 70% of the time. This line graph tracking a rising market shows exactly why. Because the market constantly drifts upward while your cash sits there earning nothing, the absolute bottom of a rare crash almost always sits at a price level physically higher than where you could have just bought years earlier. Take away the crystal ball, and the math falls apart completely. If you miss that exact bottom by just 2 months, the dip buying strategy's win rate plummets from 30% down to 3%. Real humans staring at a red screen don't miss by 2 months. According to research firm Dalbar, they usually do the exact opposite. They freeze. They panic. During market drops, average investors consistently pull their money out right before the market rips higher. Buying the dip fails in the real world because it asks for the most aggressive courage at the exact moment human beings are psychologically wired to be terrified. Let's stretch that gap across a lifetime. $100 dropped into the market back in 1928 and left alone is worth well over $1 million today. That same $100 kept perfectly safe in cash is worth about $2,500. Same century, same starting money. Carol has generational wealth, and Cole can barely cover a nice dinner. To be clear, if you already have investments, steering existing money back into stocks during a crash is incredibly smart. That is disciplined rebalancing. But hoarding cash while you wait for that crash to arrive is a trap. Cole failed because he bought into the illusion that cleverness is the point. He convinced himself there was a perfect, optimal moment out there worth waiting for. Cole thought his edge was predicting the market. Carol proved that the real edge was removing her own human ego and fear entirely. By buying on the way up and on the way down, she turned the scariest moments in financial history into her best purchases without feeling a thing. The market does not owe you a crash. And while you sit on the sidelines waiting for the perfect moment, the only thing compounding is the cost of waiting for it.